Okay, welcome back. So where we were last time, we were just like figuring out the rest of the using an aging method to figure out allowance for doubtful accounts. So we finished like multiplying across so, like the 40,000 multiplied by the 1%, the 15,000 multiplied by the 20%. We got these numbers. So then you just add them up and you get 6,400, and that's what your allowance for doubtful account should be, like the balance. So this question didn't have like a beginning balance for allowance for doubtful accounts. So this is just going to be the estimate or the adjustment number. But if it had like they had a debit balance before they did that, then you would have to, adjust it a little bit based off of, I'll just show you. So let's say before they did this, they had a debit balance of 200. Now they want the number to end up being 6,400. So the adjustment they're going to have to make is going to be a credit of 6,600. All right. Let's kind of continue what we were talking about last time. All right. So now for number 3, we're going to talk about what happens like during the year, actually. What happens when a company calls them and says, hey, we're not going to be able to pay you what we owe you. So when we set up an allowance, we already debited like a bad debt expense, and we already like set up an allowance. That's why it's called an allowance for doubtful account. So all we do is we just kind of like lower the allowance, what we were doing here with this T account when we had like numbers in here. So obviously allowance for doubtful accounts is going to be debited. So let's make our T account. What else is happening besides our allowance for doubtful accounts going down? Well, we're not gonna, we can't collect that receivable anymore because they say they're not going to pay us. So our accounts receivable are going down. Now, allowance for doubtful account is being debited, right? And accounts receivable is being credited. But since allowance for doubtful accounts is a contra asset that usually increases with a credit, and now we're debiting it, it's actually going to increase our assets. So our assets are increasing and they're decreasing, so therefore the answer is D. Has no change in net assets. Alright, so now here we're going to talk about some things, and we just have to label it if it's cash or a cash equivalent. So yes, if it's cash or cash equivalent, or no if it's not. And remember, like cash equivalent, just kind of think about like what, kind of like in your life, like if you have cash, what's like currency, that's cash, right? And if you have a balance in a savings account, even though you necessarily aren't going to use it for a while because it's in a savings account, it's still cash. And if you have a check, you write something out, it's basically cash. So just kind of keep that stuff in mind as you go through these questions, and then I'll talk about them. All right, so right away, kind of like the first 3, like I was kind of giving a hint before, they're going to be cash or cash equivalents. And this is a Y for yes. All right, so inventory for sale to customers. This is not a cash or cash equivalent, because even though inventory is very liquid, which means we can convert it to cash pretty quickly, it's not as liquid as cash. Cash is the most liquid asset. So yeah, and inventory is like another account that we have, you know what I mean? So it's not cash or cash equivalent. Accounts receivable, same thing. Accounts receivable, pretty liquid, not liquid as cash, and we already have an account for accounts receivable. Investments with maturities of less than 3 months. So this is, because remember, the whole thing with cash equivalent for investments is if it has a maturity date of less than 3 months. So this straight up tells us less than 3 months, so it is a cash equivalent. So money held as a compensating balance for a loan. So this is the one kind of like complicated one. So it is money, but it's not money that we're gonna like be able to. It's restricted cash. So I'm actually not sure if it would be labeled as a cash or cash equivalent. Let's just go. Just keep in mind that it's restricted cash. So it is cash. It's just like we can't touch it, and we have to like keep it somewhere as like an agreement. Let's actually see if I can get some notes up here. It's like a restricted cash is a compensating balance on savings account or money held in escrow, which means controlled by like a third party as part of a loan agreement. So like they're saying, okay, we'll give you this loan, but you have to give us like $100,000 in some account so that we can get it in case you don't pay us. And it should be separated from normal cash balance and disclosed in the note. So I'm gonna go ahead and say that it's not cash, even though it's money. So yeah, that's restricted cash, and just keep that stuff in mind. And then also from chapter 6, remember the internal control stuff. So the 3 triangles of fraud. So opportunity. So like somebody has the opportunity to like fraud the company. Financial pressure. They want the money, so they're gonna do something naughty. And rationalization. So basically, an employee thinking that doesn't look too good. That says rationalization. So basically, a employee saying this company makes so much money, who they're not going to notice if a little bit's missing. So those are the 3 triangles of fraud. Just keep in mind that stuff. Look at your chapter 6 handout, and yeah, just keep that stuff in mind, and you understand the problems that we went through. God, I can't drag this thing. You should be good to go. So, yeah.